In this video, we want to talk about dividends and repurchases of stock. And this is, I think for most people, we think we understand what dividends are all about, but we are actually looking at dividends from an investor's perspective. In these videos, we want to look at dividends from a management perspective. What does management think about dividends? What do they think dividends will do to the value of the company's stock? So again, dividends and stock repurchases, that's the big question. Managers want to increase those if possible. We want to pay more, get higher returns to our owners. How can we do that? And obviously it comes from cash flow, from the free cash flow of the company. So what is a distribution policy, right? We need to figure out or try to determine what is the level of cash distributions to get to shareholders, what is the form of that distribution, and of course, let's think about stability, right? What is the certainty that we'll be providing to shareholders so they can have an understanding of what they can expect from the company? Now, when we think of the form of distribution, this just refers as dividends versus stocks, but we also can think about the dividend as being something other than cash. It could be a stock dividend, which we'll talk about when we talk about capital structure, but there are other forms of dividends than just cash dividends. If we look at the yields and the payout ratios for different industries, you can see there is a wide range. There is absolutely a relationship between the dividend and the dividend payout ratio and the industry that we're talking about. Typically, higher technology, especially internal kinds of technology, companies will tend to pay higher or lower dividend rates than others. Any company that's in a growth mode is going to reduce dividends most likely to help finance some of the growth. So each industry is going to have different thoughts, if you will, or different patterns or strategies of, number one, how much to pay out. Now, the dividend yield is the relationship between the dividend payout, the actual dividend itself, and the price. And of course, again, you can see there is a wide range. Now, the lower dividend yields could either be from higher prices or lower dividends. So it's a little bit more complicated question. In this particular videos, the next two here, we want to talk more about the ratio. How do managers decide how much to pay out? Having said that, I think there's an unfortunate little circumstance, and that is that there's no real answer to that. There's no ratio or technique that we can apply that will tell the management of the company how much to pay, when to pay, the form to pay. That really doesn't exist. So what we have to think about are relationships. If I make a change, how will that affect the relationships inside the company? In particular, when you think about dividends, we want to think about the relationship between the company and its investment strategies, right? The more we're investing, the less we want to pay in dividends because we want to use profits to invest in those things. And we want to think about our shareholders. Do they want more or do they want less? How is it going to affect their perception and the relationship we have with them? How is it going to have an impact on that? So, do investors want high or low payouts? There are three dividend theories currently in place, I guess. One is that dividends are irrelevant. Investors don't care about them. Dividend preference, or what's referred to as the bird in hand theory. This states that investors prefer a high payout. And then there's a tax effect. Investors prefer a low payout. And I think just at quick glance, you can see that these three theories all propose different alternatives, different outcomes. I think it just goes to highlight the very complexity with any kind of dividend payout, any kind of financing decision. There's many different variables at place that complicate our thinking about this answer, this question. So the first model we have here is the dividend irrelevance theory. Basically, it says we're indifferent between dividends and retained earnings. A fundamental kind of understanding here is that if we make some assumptions that there's no taxes and kind of clean up some of the financial environment, it basically says, look, if the company's not going to pay you a dividend and you want cash, you can sell the stock to get the cash that you want. And then again, if you don't want cash, right, the company can use the dividends to buy back the stock so that we can create what's sometimes referred to as homemade dividends. Investors can create the kinds of cash flows that they want. Now, it requires them to either buy or sell stock to change that relative position. Two theorists, again, this has been around for many decades, Modigliani and Miller, basically support this basic idea. It implies that the payout policy has no effect on stock value or the required rate of return on stock. And again, as we mentioned, it has some pretty unrealistic assumptions. And especially when we get to talk about capital structure, we'll see how some of these assumptions are how they're relaxed, and then what impact that has on our decisions. The bird in hand theory says that investors think that dividends are less risky than potential future capital gains. Again, it's the bird in hand. Getting dividends in cash is far more certain than waiting to see what's going to happen to prices in the future. So investors want dividends. High payouts as well help to reduce agency costs. If we're taking cash out of the company, this makes it more difficult for managers to maybe squander some of that cash. It makes them become more accountable for their decisions, especially on the financial side. So therefore, again, investors would rather have high payouts. They would rather and it would actually require a lower return to induce them to buy the stock. They want more dividends. And the idea is if they want more dividends and the company's paying them more dividends, that should be reflected in a higher stock price. The tax effect theory basically has the exact opposite outcome. It says investors want low payouts because of the higher capital gains on, they want lower payouts because that's going to imply if they get cash, if they get dividends, they're going to have to pay taxes on that. So capital gains are deferred, which means I don't have to pay tax until I actually sell the stock. So that means, again, there's a lower effective rate on dividends than on capital gains. So let's think about this tax effect theory. What does that mean? Nobody wants to pay taxes. If you receive dividends, you pay taxes today. If you don't receive taxes or dividends, and if the money that was reinvested results in higher stock prices, you'll have capital gains. And capital gains taxes are deferred till we actually sell the stock. So even if they're the same, even though they're equal in percentage, one you pay taxes today, the other you pay taxes in the future. So this would require investors, if the company has a high payout of dividends, that might make them uneasy about having to pay taxes on that today. They would prefer then to have lower taxes, lower dividends rather than higher dividends. So let's see what research tells us, right? So let's think about dividends and required returns. Research shows us that investors require higher pre-tax returns on stocks in high payout companies. So what does that mean? Higher pre-tax returns implies lower prices. That is, if you're going to pay out a lot of dividends, investors they're not happy with that. So they're going to want to pay lower prices. So there are lower prices associated with high dividend companies. Now, taxes alone can't explain this difference, right? There are lots of things that come into this. But this result here kind of supports the tax effect, right? It's not totally conclusive, but it implies, and I think we would all agree, that taxes are always important as a factor when thinking about any financial decision. What about international evidence? Different companies have different tax laws. So we can kind of look at countries and companies within those countries and how investors in those companies relate to the payout of dividends when they enjoy different types of taxation. So they refer to this as being the dividend tax penalty. Now, what does the research show us? In countries that have relatively low dividend tax penalties, that is what? They have lower taxes on dividends, more companies tend to pay dividends. And the dividend payments are actually larger. So what does that tell us? Investors are cognizant of taxation, and they are much happier when they pay less taxes. And the companies reflect that in their dividend policy decisions. Now, in countries that have relatively high dividend tax penalties, more companies repurchase stock. If you're repurchasing stock, the tax you pay is not a dividend tax, but you are still most likely paying a tax on capital gains. Again, this evidence doesn't directly support the tax effect hypothesis, but again, it does show that taxes have influence. What about changes in tax code? How does that affect us? In 2005, Congress reduced the tax rate on dividends to be equal to the tax rate on capital gains. That had an immediate influence on changes in companies paying taxes. Although it's kind of anecdotal, right around this time, prior to this tax change, Microsoft never paid dividends because individuals were paying their marginal tax rate, currently around 38%, versus capital gains that were at 20%. So when they reduced the taxation on dividends, companies started paying dividends, and Microsoft started paying dividends to their investors. Why? because they were going to keep more of it once they reduced the actual tax rate on them. In 2013, Congress enacted law to bring tax on dividends and capital gains permanently down to a maximum of 20%. What about uncertainty about tax laws? 2010, 2012, there was a fear of tax increases on dividends. So late in 2012, lots of uncertainty. There were additional special dividends paid out. Why? We thought dividends taxation was going to go up, so companies started paying out more dividends before the rate change. It implies that what? Companies are cognizant that investors don't want to pay taxes. So 176 companies actually changed their payment date, right? So over $12 billion in what they refer to as sooner than normal regular dividend payments were actually paid. If companies had higher inside ownership, they were more likely to pay these special dividends and accelerate the payment dates. Why? The insiders have lots of ownership, obviously. They don't want to pay taxes on that stuff. And again, we still get the same kind of info. It says, really, there's no evidence that says the tax effect is correct, but it sure seems like a coincidence that taxation is at the bottom of all of this activity. So how do agency costs affect dividend payout? So what are dividends? Dividends are cash. So if companies pay out lots of cash, that means there's less cash for managers to play with. So if companies have a legal system that has weak protections, then it's likely that managers will pay lower dividends because they want to be able to use the cash how they see fit. So these agency costs are those things that hurt the investor. So low dividend payouts make more cash available. So what we find is in countries that have poor investor protection, typically that is where agency costs are maybe not quite as big as others, right? High payout companies are valued more highly. That is because if you pay out more dividends, that means there's less money to play with than low payout companies. So again, this implies this idea that investors want managers to make the right decisions. They want them to do things that increase their value, and agency costs reflect a situation where management is not necessarily doing the best thing for the investor. So what's the overall summary of these empirical tests? Taxes certainly affect dividend policies. There's evidence that investors prefer to avoid taxation. There's also some evidence that investors require higher pre-tax returns on companies that pay big dividend payouts. So think about the relationship between returns and prices. Higher returns implies lower prices. So again, companies, individuals, investors, typically are concerned about getting paid very high amounts of dividends. There is a concept of something called the clientele effect. Now, the clientele effect is basically, an agreement with the irrelevance hypothesis. Basically, it says companies reflect certain kinds of investors. These investors are not just interested in the level of return, they're also interested in the type of return. So if we had two companies here, A and B, that are identical companies, identical in every way, they both earn 10%. So the question is, as an investor, if these are identical companies, which of those would you want? Again, if they were identical twins. Of course, the answer is you wouldn't care. However, what if the difference is not the company, but the form of this return? What if this company has 10% in the form of dividends, and this company has 10% in the form of capital gains? Now, because we understand a little bit about taxes now, we know what? These investors don't get 10%. These investors are going to get 10% less their marginal tax rate, right? So they might only receive 20%, or 80% of the 10. However, capital gains, they're not going to pay taxes until they actually sell the asset. So if I was a manager, right, let's say I'm the manager of company A, and I now say, hey, we're going to start holding dividends. We're going to reduce dividends. That means we're going to move over to this form company here where there's more capital gains, which is less taxation. What would happen to the price of this stock if we started selling it over here? So the idea here, the first thing you might think is, well, this is supply and demand, right? That if I'm going to change the demand, something's going to happen. The stock price is either going to go up or down, depending on which direction I move here. But supply and demand, the change in demand only works if nobody wants to buy what you have. These investors over here are certain kinds of investors. They want capital gains. These investors over here, they want dividends. They're selling because they're getting less dividends. And again, supply and demand says normally the price would change, but because somebody over here is equally willing to buy it, the demand curve really doesn't change. So what the clientele effect says is when companies change their dividend policy, nothing really happens except we now have different owners. The ownership changes, and the company doesn't care who owns it as long as somebody buys the stock. The last theory to kind of think about is something called the signaling hypothesis. The signaling hypothesis says that investors look at dividends as information. When managers change the dividends, they're sending a message to the ownership about what's going on inside the company. Now, I don't want them to tell me what's going on, because if they tell me, they tell everybody, right? But managers, we know they don't like to reduce dividends. That's going to upset me as an investor. So they hate to cut dividends. So they're not going to raise dividends unless they think it's sustainable. It's only sustainable if something really good is going to happen. On the other hand, if they reduce dividends, you and I see that as bad, we would then assume that the stock price would ultimately fall. So a stock price increase, right, at the time of a dividend increase, just tells us there's higher expectations for future earnings, right? We see a signal. A reduction of dividends is a bad signal. An increase in dividends is seen as a good signal. So that's the first half of this. It's not really all that complicated, but it's a different way of thinking of the repurchases or of the distribution of dividends to owners. See you soon.